Hey, Mike, good morning. I think again, with all the conversations that we've been having recently, I really wanted to challenge you this time because some of the topics, we're pretty knowledgeable on, and
Hmm.
to some degree, maybe, little soft questions
Sure.
in some cases. I think let's just make this a little bit more challenging today. There's so much noise out there. I wouldn't even say noise, a lot of different storylines of what people's predictions are going to be for 2026. Some
Hmm.
people are saying property value is going to be dropping significantly. Some are saying, increasing.
Hmm.
Maybe give me your take as far as like worst. Well, I guess what's your bearish,
Yep.
perspective, and what's your bullish perspective, and then what's your opinion? You know what I mean? Because there's always
Yeah.
so
This
so.
is
Let's make this a more
this
meaningful
is.
conversation.
I think this is going to be fun.
Okay.
Nobody's asked me this before to do
Mhm.
this, and I think more people should. So I'm going to be a housing doomer, then I will be a housing bull, and then I will give you my opinion. That's kind of what you're asking, right?
Well, yeah. I mean, there's I think varying degrees of reasons for both sides to
Sure.
kind of like, what, that's plausible. But
Yeah.
I can, want to hear other people's opinions just because
Yeah.
when you get a lot of different perspectives, it kind of allows you to get a better oversight of everything.
Okay. So if you're going to have a major housing collapse or crash in 2026, I think there's several things that have to happen near the same time. It's like that combination of things that occur that then forces a drop in prices, right? It's kind of like in bowling, it's the pin action, right? I don't think there's one thing that happens to drive prices down 10, 15, 20% in 26. But
Mm,
if you get multiple pin action,
right.
anything is possible. And we certainly could see a crash. So when I first think of the bearish case for housing. And to be bearish, let's say a 10% drop in national median home price or greater, right? That's
Okay.
that's the bar, right? That's bearish in my opinion.
Okay.
The first thing has to start with the job market,
I was gonna say,
right?
what's the first pin?
Yeah, the first pin is the job market. And
I,
we need to see meaningful increase in weekly unemployment rate, right? We
mhm.
just got a report today, 191,000 cycle
Right.
low,
Right.
not there. But that has to go to 325,000 or greater. That's pin
Mm-hmm.
action number one. That's going to then drive the unemployment up from 4.4 to probably 5.5, maybe 6.
Mm-hmm.
We have to see continuing claims, which again fell today to 1.9. That's got to go to 3 million or 3.3 million. So the first pin
Which
action is we have to see massive unemployment
Right.
quickly. Go ahead.
I wanted to interject. Some of those employment readings, would you say some of that has to do with more seasonal numbers? Because again, usually around, the holiday seasons, people might get like temporary jobs or
Sure.
whatever, stuff like that. So yeah,
Yeah,
I think in the coming months, I think the jobs reports will give a more a clear indication.
for sure.
But yeah, I think jobs. We talk about this off camera a lot as far as like the jobs market. I think is
Yep.
really going to be the one factor that's really going to be the driving force, bearish or bullish. But anyway, I'm sorry, I didn't mean to interject.
No, this is fun to talk about because again, nobody's asking me to give a bearish, bullish in my opinion. So again, the bearish case starts with the unemployment.
All right.
Next up, again, it's multiple pin action. So the second pin has to be foreclosures,
Oh yeah.
right? Um, we are seeing uh, growing foreclosures, right? We're
Hmm.
seeing up 20%. But again, let's be real. Like if you go from 10 to 12, that's 20%,
Right.
right? Last time I saw foreclosure numbers, they were about 50,000. And
Right.
back in the GFC, we're doing that 50,000 a month. We were
Hmm.
doing 250 and 300,000 a month. So the
Right.
scale is not even close.
Right.
But we probably would have to triple foreclosures. And again, that is possible,
Hmm.
right? We have a lot of garbage um, from the last 3 years, extend and pretend. We've got people going back for third and fourth modifications. That
Hmm.
stuff should have been foreclosed years ago. It is possible that it's not probable, but again, if we're playing bearish case,
Hmm.
all that inventory has to come on the market near the same time unemployment is spiking. Because when that happens, if you get an unemployment spike with a bunch of foreclosures, that will create comps
Hmm.
that then become comps for these other unemployed that may be losing. So it becomes this loop, this negative loop.
Right.
that feeds on itself.
Right.
And
Right.
here's the third pin action. And this third one is important. And this is the one that I think most doomers miss, but is again possible. We are going to get a new Fed chair.
Mm-hmm.
Based on an article in the Financial Times that I read this morning, the pick is going to be Kevin Hassett, and the bond market doesn't like it.
Hmm.
So the third thing that has to happen,
Interest rates.
Stephen, besides unemployment going up, foreclosures tripling, is we have to have interest rates go higher, not lower.
Right.
So again, if we see mortgage rates, because again, the Fed can cut all they want. That's the short end. If the bond vigilantes go F you, middle finger, and they take us to 8% mortgage rates, you could see a 10% crash in home prices in 2026. So again, the pin action for the bearish story, dramatic and sudden rise in unemployment, a dramatic and sudden rise in foreclosures. I mean, completed, not filings.
Right.
I mean, actually foreclosed. And we have mortgage rates at 8%. You get those three things to happen in Q1, Q2, you could see dramatic price drops. So that's my bearish case. That's my pin action for the bad story.
I mean, I agree with a lot of that. I think some of my thoughts to that would be lenders nowadays are going to maybe work more so with borrowers as far as foreclosure, only because what they saw what happened last time with mass amounts of foreclosures that just decreases the value of their assets in the long run, and so it just self perpetuates just this negative downward spiral. And so if they can hold prices kind of steady with modifications to some degree and kick the can down the road, it does kind of soften and soften the blow a little bit as far as the landing if they do got to foreclose, because again, values may not just fall through the floor. But yeah, I would agree with a lot of those points. But yeah, this is a lot of fun actually. This is something we never gonna get to do. But anyway, but yeah, those are all great points. But
All right, so
on the
now let's
opposite side, let's play devil's advocate.
Now let's do the bull scenario. And again, I want to be clear. I am not a bear or a bull. People really miss that, and you'll see that when we talk about what I think. But when you look at the bullish case, again, I think it's pin action, because I'm actually seeing people talk about 7, 8, 9% price appreciation next year, which I think is crazy, right? I think it's crazy to call that. But again, if you look at the pin action that could get there, it's certainly possible. So in scenario number one, the bearish case, it was unemployment. In scenario number two, it has to be interest rate. Pin action number one is interest rate. And specifically, we're talking 30-year mortgage homeowners. So again, I have often said and have receipts that if we could get the 30-year mortgage to 5.5, or heaven forbid 5, game over. Game over. Right? So again, we would need to see meaningful interest rate drops, which is not unheard of, right?
Right.
We've seen the 10-year note today is roughly where it was a year ago, but mortgage rates are still 50 basis points better. Why? Because of the spread.
Right.
So as of this morning, we still have about 40 basis points in spread that could come out just to get back to average of 180 basis points. Right. So that would take us from 6.2 to 5.8. If we get, if Kevin Hassett comes in, we get a Fed rate cut in December, we get 2 more in Q1. And then, oh, by the way, again, the Fed starts buying mortgage-backed securities.
Ooh.
Hello.
Turn on the presses.
Turn on the printing presses, right? So again,
Steve Dowd needs to take a bunch of vitamins to stay.
Yeah, he's going to have to heal up. Yeah. So again, the first pin in the bull case is lower rates, and I want to be very clear: sub 5.5.
Jeez.
Right. That's where the bull case comes in. I don't think we get. I don't think we see 5.5. In fact, I'll go as far as to say I hope we don't see 5.5, because I don't want to see.
I mean, the timing, sure, slow drop, like a feather, and not
maybe.
like a heavyweight, because otherwise the market's gonna overreact. Oh, Jesus,
be ugly.
It's gonna be like maybe good for me, you know what I mean?
Yeah, but short in the short term, you'll be good in the short term. But when you look out at your business,
like 6 years,
you're like, I'm out. I'm good.
I've tripled my income every year for the next 6 years. I'm good. That's
you know what
I mean?
There you go. Stephen Dow's good. He's out. He's out. Whoop. Out. So step 2 has to be the job market.
Right.
The job market cannot fall apart.
Right.
So I would say the unemployment rate needs to stay below 5% for the year,
Right.
right? So we can go a little higher, but
Mm.
nothing wacky, right? So again, dramatic lower rates, a job market that doesn't fall apart. And then again, kind of that third pen is we have to have demand incentives from the president. The administration needs to come out with something that gooses demand. It could be a 50-year mortgage.
Affordability. Right.
Yeah,
Right.
well,
Right.
it could be a 50-year mortgage.
Mm.
It could be no federal taxes. You want to see, dude, you want to see housing prices go up? Get rid of the IRS.
I know. I know. With all the tariff money that they've been talking about, they've been
Yeah.
getting,
I mean,
they've been tossing
just
around
get,
that idea like no income tax.
yeah. Hello, Stephen. You live in Texas. You have no state tax and no federal tax. How happy are you? Right? Come on. Right? So again,
I'd be crying. I'd be crying
yeah, you'd be so
with
happy.
joy. Oh my goodness.
But
Oh my
again,
goodness.
that would have ramifications for all assets, let
Oh,
alone
agreed.
housing. Right? You
Agreed.
drop 20% to the bottom line for families, right?
Ah, from
So
your lips
again,
to God's ears, please make into fruition. I think we're going to speak it into the universe.
there you
No,
go. There you go.
no income. Oh, wow. That'd
Yeah.
be incredible.
And then the last thing is it's still very, very possible. Again, I'm not calling for this. I'm just trying to paint the rosy picture about how we get
Sure.
7, 8, 9, 10%.
Mhm.
Is we have a first-time homebuyer program of some
Right.
kind.
Right.
Either, because again, you could create a program that says, hey, buy a home, get 10 grand.
Right.
You could create a program that says every first-time home buyer below some level gets a 4% interest rate,
Right.
right? You could do a 3. I mean, they could do anything they want.
Right.
And, so again, I think if you're on the bull side and you're talking 7, 8, 9, 10%, you have to have multiple pin actions. Rates below 5.5, a job market that doesn't get worse than 5% unemployment, and you have to have federal demand creation. You get those 3 things, that pin action, housing explodes next year.
So much exciting stuff to kind of think about. I mean, there's all these different moving parts this because again, there's so much optimism rolling into, I think, at least from where I'm sitting, going to 2026, you know what I mean? Um, Outside of all the, mass media talking about, all these other things that I don't think are, that impactful as far as what real life stuff is, as far as finance and stuff. But I think, yeah, in the near future, I mean, growth, I think, is coming. I think in many areas. I mean, we're doing very, very well. I don't know, in other areas, but I feel, yeah, optimism for
Yeah.
2026. You know what I mean? I don't think there's so much negativity. The only thing that we talk about a lot of times is the job market. And I think if
Yeah.
that stays steady and there's emerging industries, I think, due
Yep.
to, other areas, I think the blue collar type businesses and
Yeah.
jobs that
Yeah.
are a little bit more AI resistant are going to be emerging. I think
Sure.
if you're wanting thinking long term and you want a little bit more, job security, I think those are going to be something that's going to be coming up big. So
Absolutely.
yeah, the trades are going to be doing well and
Mm-hmm.
everything else. But yeah,
Yeah.
otherwise, what you said, please, yeah, make that happen. 50-year
Yeah.
mortgages, 4%. Yeah. And then, because
Yeah.
again, with maybe some of that tariff money they talk about, maybe they can create some of these
Yeah.
programs with some of that
They could.
money,
They could. Yeah, absolutely.
and that would just, yeah, be a
Yeah.
good
Yeah.
catalyst for young homeowners. I think that'd be good. I'm just kind of thinking all these different scenarios on how that all play out, and so I think that's a
Yeah.
positive stuff.
Yeah. So if I now come back to what I think for 2026, so I gave you the pin action for
Yep.
the bear, pin action for the
Mm-hmm.
bull.
Mm-hmm.
I think we just stepped through it. So where do I think interest rates are
Yeah.
in 2026? I think they will average 5.9. So again, not 5.5, not 5.
Mm-hmm.
I think they average 5.9. So it's helpful, but not crazy.
Yeah.
Next,
Yeah.
yeah,
Hopefully the slow trickle, but yeah, let's hope. Otherwise, that sudden just knee jerk and
yeah,
we drop like 2 points or something. Ooh,
couldn't imagine.
Yeah. No more
So then
no more global pandemics.
then the job market. I think the job market is certainly weaker than a 4.4% unemployment rate. I think it gets worse. I think it touches 5, might go to 5.2, which is it's millions of people unemployed, but it's not 7% like in the bear
Right.
case.
Right.
Now
When do
we'll
you think
talk
that's going
about.
to happen, though? I mean,
I think it
possible as far as when we're going to get that.
by the middle of the year.
Okay.
Yeah, by the middle of the year. As for foreclosures, again in the bear case, I think you
Mm,
brought up what's going to happen. Extend and pretend. I think it's going to be a trickle. In the bear case, remember they all had to come seemingly
mm-hmm.
at the same time, which creates that oh my god
Yep.
supply bounce. I think banks learned their lesson last time, and they're going to trickle it out and extend and pretend for frankly years to come.
Mm-hmm.
So that won't be there, but it could. Um, and then I actually do think the administration, kind of the third step of the pin action, is going to create some demand stuff, but I think it's going to be on the edges,
Okay.
right? I don't think it'll be a massive thing. Like to an earlier point, I don't think the IRS is going away. I
Right.
don't think federal taxes are going to zero.
Right.
I don't think we're getting a 50-year mortgage,
Okay.
but it's pretty clear something is coming.
Mm-hmm.
But I think it will be more
Soft.
noise than signal. Yeah, soft. I
Gotcha.
think it'll be,
Yeah.
it'll help 10,000 people, not
Right. A
10
small
million
down
people.
payment. Yeah. Down payment assistance program for first
Yeah,
time,
for like this little widget of people. Yeah,
right. I
something
can
like
see
that.
that. I mean, yeah. Let's hope that it's more than just noise or just a slight, like you said, on the fringe of just a small demographic that's going to benefit.
Yeah.
Unlocking, I think, equity and allowing maybe move up buyers. I think that's where a lot of
Well, that's the
trapped
ring.
money's at.
Yeah, that I that's coming,
Hmm.
but I think that's 27, 28. I don't
I
think
think so
that's
too, because all the
26.
loans that were done before, yeah, because all the 2 point something something 30-year fixes, I ain't doing, and yeah,
No.
I'm locked in.
Yeah.
So
There you go.
yeah,
Man, this is a lot of fun. I appreciate you thinking of this topic. Again, give me the bear case, give me the bull case, and tell me what you think. So, yeah,
yeah.
I think 2026 is going to be a lot like 2025. We're going to do more transactions. I do think the mortgage business.
Hmm.
I actually think the mortgage business goes up 20% next year,
I mean,
maybe
hopefully,
25.
and that would be great for people that have been in, still in the game this whole time. You know what I
Yeah,
mean?
because the
Um,
refis are going to go up. Yeah,
oh,
refis are going to
agreed,
go up.
agreed. Now, all of this, by the way, although I work very happily for
Ah,
Velocity Mortgage
yes.
Capital, all of these topics and ideas that we just discussed are that of my own. So, other than that, if you still need to reach me, my email is below, sdout@velocitymortgage.com. Subject line, please put the acronym ORAAT so I can find you. It's been a several day kind of delay only because with the holidays, so I will be getting back to everybody today. On a side note, me and Mike talked about this off camera. I had somebody recognize me out here near Austin, Texas, which was a really
That's
funny
nice.
surprise. Yeah, so I don't want to give away their full name, so I don't want to.
No, no.
But yeah, nice to
Yeah,
meet you again.
if you see
Yeah.
Steven Dow in the wild, say hi. He's a great guy. He's a great
Yeah, it
guy.
was kind of fun. It was a really neat experience. Like, it was just fun to kind of have a nice face-to-face conversation. But really nice gentleman. Had mentioned, he's in the Orat family and first time smaller investor. I mean, a couple of
Yeah,
properties up and around the Alabama area. Still looking,
nice.
but yeah. Anyway, we exchanged, contact
That's
information.
cool.
But yeah, it was a nice, lot of fun. I just wanted to bring it up because the channel, I couldn't believe it.
Yeah,
I
it's
mean, it
pretty
was such
cool.
a small world. I'm like, oh. So I just wanted to bring that up. But anyway, thanks again, Mike. Appreciate you, brother.
You're amazing. Take care, family.